Good morning, it's Thursday, 4th of November. I'm Tom Elliott and welcome to my market report. Well, last night in the US, the aptly named QE2, that's quantitative easing number 2, was announced by the US Federal Reserve, a bit bigger than expected. They're going to buy $600 billion worth of bonds and bills from the US government. The hope is, of course, that this money, which effectively has been printed by the US Federal Reserve, will make its way through the US government to the banks and then lent to consumers in the American economy, and thereby lift economic performance. We don't know if it's going to work or not. Experiments of this sort of thing with monetary easing in the past have not always worked, but the Americans have run out of ideas. Now, here in Australia, the market's up about 0.4%. The Dow rose 0.2% last night in response to the QE2. Of course, we have a monetary problem the other way around. In America, they're trying to loosen monetary conditions, but in Australia, of course, the Reserve Bank took what many thought was a fairly bold step on Tuesday. It increased official interest rates by 25 basis points, and within an hour or so, the Commonwealth Bank of Australia, the biggest domestic lender, increased its lending rates by 45 bips, almost twice the official rate rise. Now, what this has done is made many people realise that there is no longer, and there hasn't been for some time, really much of a link between what the Reserve Bank does and what the commercial banks do. Some would say it was a very bad PR exercise by the Commonwealth Bank to, if you like, rub the government's face in it a bit. It's possible that the Commonwealth, and we'll soon find out what the other banks are going to do, what they're really doing is the Reserve Bank's dirty work. The Reserve Bank is sort of quietly saying, we want money to be more expensive in Australia to hold back the housing market, to constrain inflation and so forth. Anyway, I think the Reserve Bank was wrong. Glenn Stevens actually admitted that currently underlying inflation is only 2.5%, and that's bang where it should be. And this idea that the continued boom out of China will automatically lead to more Australian inflation, I think is a false hypothesis. If anything, the boom out of China is going to keep the Australian dollar strong. And speaking of that, it burst through parity this morning. It's currently 1.0035 US cents. It's been almost as high as 1.007, so parity has been achieved. And of course, the strong dollar, in terms of inflation, it makes imports cheaper. So if anything, I think the boom out of China could be good for Australian inflation, not a danger. Anyway, turning to the stock market, bank stocks have been mixed since Tuesday's rate rise. Some people are getting genuinely concerned that the government might propose a thing called a People's Bank to compete with the big banks. It would probably be a dumb idea, but it's not beyond the realms of possibility. Retailing stocks have been hit reasonably hard since the rate rise was announced 2 days ago. Stocks like JB Hi-Fi, Harvey Norman, Myer, David Jones, all weaker because, of course, higher interest rates have a very real impact on the budgets of Australian households. Christmas is coming up, and the worry is, of course, that people won't have as much money to spend or won't be as willing to spend money, and that, of course, isn't good for retailers' profits. In corporate activity news, BHP has had its bid for Potash Corp of Saskatchewan knocked back by the Canadian investment regulator. This is a surprise to many people. Canada normally has a very open attitude towards foreign investment, as does Australia. And in this case, it's decided that Potash Corp is important. I think what's really happening here is that there is a provincial election in Saskatchewan coming up. I think there's also a federal election in Canada. And in this case, we are the bad guys. That is, Australia are the evil foreigners coming to buy important Canadian assets. Curiously, of course, plenty of Canadian funds have been buying Australian assets recently, so the flow definitely goes both ways. Foster shares were down a couple of cents. Its erstwhile shareholder, Molson, which had just under 5%, has said that it plans to sell that shareholding, so that's obviously one party that won't be making a bid for Foster's anytime soon. Foster shares had run up a lot on the prospect of a bidding war, possibly between SAB, Miller, Kirin, and maybe even Molson Coors. Molson Coors is now out of the picture. And Westfield shares are in a trading halt still. The company's announced a bold plan to de-merge a big chunk of its Australian shopping centre assets from its US ones. The US assets that Westfield has are an obvious drag on its share price because the US dollar is weak and US spending is weak. So they're going to create an Australia-only property trust that Australian investors might find quite attractive. They're also going to raise $3.5 billion. Now, this could be used in the short term to retire debt, but the feeling is that Westfield is going to go on an acquisition spree, and many people have looked at the Centro properties, which could be up for sale. Centro, of course, is in a lot of financial problems. They could be attractive to Westfield after it's raised this $3.5 billion. So interesting times for monetary policy, for stocks looking to de-merge and raise money, and I'll be back next week to tell you more about it.